All right, let's just jump right into it. Today, in this explainer, we're putting OI Glass, ticker symbol OI, through what I like to call the ultimate valuation gauntlet. As an investment analyst, I absolutely love taking a company that the market is currently punishing and running it through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some modern discounted cash flow models. So we're going to unpack the data to uncover if OI Glass is a hidden gem just waiting for a turnaround, or if it's simply a value trap.
I mean, get a load of these numbers. An 87.5% nosedive in Q1 earnings per share. We're talking a drop down to just 5 cents from 40 cents a year ago. No surprise, that massive plunge sent the stock price into a total tailspin and triggered a wave of investor panic. But as you know, the market can sometimes completely overreact to short-term pain, missing the long-term fundamentals entirely.
So, did the market overreact? We're going to find out by breaking this down into 5 quick parts, starting with a company snapshot, then running it through 3 legendary investor lenses, checking out some DCF and alternative models, and finally pulling it all together for our verdict.
Okay, part 1. Let's get a snapshot of exactly where the company sits today.
Consider this massive gap for a second. We've got a $1.41 billion market cap, but an enterprise value of $6.05 billion. Since enterprise value bakes in debt, that nearly $5 billion difference is practically screaming that this company is drowning in debt. For a business bringing in roughly $6.4 billion in annual sales, a market cap this tiny tells us the equity is super leveraged, and frankly, the market is deeply, deeply skeptical.
It's basically a massive tug-of-war right now. On one side, management is fighting tooth and nail with their Fit to Win initiative. They've already locked in $275 million in savings and scored 15 new accounts. Pretty great, right? But pulling in the exact opposite direction are some brutal macro realities. European energy inflation, tied to all the geopolitical conflicts, is creating a headwind of up to $100 million. It's just chewing through their margins and neutralizing those hard-fought internal wins.
All right, moving on to part 2, the Warren Buffett lens.
You know the drill with the Oracle of Omaha. He demands a wide, easy-to-understand economic moat, super predictable owner earnings, a consistently strong return on equity, and a squeaky clean balance sheet with manageable debt. Essentially, he's looking for a cash-printing asset that practically runs itself.
So, how does OI stack up? Well, management is definitely making some headway. Achieving cost parity between glass and aluminum cans actually really helps their moat. But the financial metrics, they just fall completely flat here. We're looking at a dreadful negative 11.26% return on equity, which literally means they're destroying shareholder value with the money they have. Throw in a massive 3.35 debt-to-equity ratio, and alarm bells are just ringing off the hook for Buffett. It's way too highly leveraged for his taste.
So, the Buffett verdict? It's a hard fail. The killer here is the unpredictable owner earnings, his strict standard for true usable cash flow. They recently slashed their free cash flow guidance down to just $50 to $150 million, leaving absolutely zero room for error. For a Buffett-style investor, that mountain of debt entirely wipes out the margin of safety required to even consider making an investment.
Okay, let's pivot. Part 3, the Peter Lynch lens.
Looking at the numbers, Peter Lynch would likely tag OI Glass as a classic cyclical turnaround. Now, this is a high-risk but potentially massive high-reward bucket. We're talking about companies that have been totally battered by economic cycles or high debt, but are actively executing a clear restructuring plan, like OI's Fit to Win program, to claw back their former profitability. If management actually pulls it off, the stock price usually skyrockets.
Let's talk about the PEG ratio, price to earnings divided by the earnings growth rate. Right now it's sitting at 1.27. Okay, so it's not deeply undervalued by Lynch's super strict under 1.0 standard, but honestly, 1.27 is pretty reasonable for a recovering asset. It basically tells us we aren't drastically overpaying for their projected earnings growth.
Now, here is a massive, glowing green flag for Peter Lynch. Insiders are buying the dip. A company director just scooped up 12,000 shares. To Lynch, there are a million reasons an insider might sell, but only one reason they buy. They think the price is going up. They are literally putting their own money on the line, backing the turnaround narrative.
Let's strip away the growth story for a second. Part 4, the Benjamin Graham lens. Running this through the father of value investing's defensive checklist, it's a bit of a mixed bag.
It completely fails on financial strength due to a weak 0.59 quick ratio, meaning they don't have the liquid assets to cover immediate short-term liabilities. In earnings stability, forget about it after that 87.5% drop. But, importantly, it easily passes the test for a moderate price-to-book ratio, currently sitting at just 1.11. Basically, you're paying pretty close to liquidation value for the company's hard, physical assets.
Now, here's where things get really fascinating. When we run Graham's legendary intrinsic value formula, which is the square root of 22.5 multiplied by earnings per share and book value per share, look what happens. Using their updated conservative EPS guidance of $1 and their derived book value of $8.31, it spits out a target fair value of $13.67.
So, Graham's verdict? While it might fail the strict defensive checklist, at the current price of $9.23, you are looking at a steep 32% margin of safety compared to its intrinsic value. For a hardcore, deep value Graham investor, that massive discount to its hard assets and normalized earnings might just be incredibly tempting.
All right, let's bring it into the modern institutional era. Part 5, DCF and Alternative Models.
To build a solid model and bridge the gaps in our data, we have to lay out our assumptions. We're rolling with a conservative 9% weighted average cost of capital, basically the hurdle rate we need to offset all that heavy debt risk. And for terminal growth, we're using 1.5%, which lines up perfectly with management's confirmed new business volume wins kicking in around 2026. Keep in mind, DCF models are highly sensitive. Even nudging that growth rate by 0.5% can totally swing the final number.
So we project out their newly slashed free cash flow guidance, taking the midpoint of that $50 to $150 million range. Over the next 5 years, we apply our 1.5% perpetual growth, discount it all back at our 9% cost of capital, and boom, we find the present value of their future cash generation. And the results? The DCF gives us a base case fair value right around the $10 to $12 mark, so just slightly above the current price. But, and this is a big but, when we look at historically normalizing their enterprise value to EBITDA multiple at roughly 6.36 times, it suggests a much higher ceiling of around $17. Normally, we'd also run a dividend discount model, but since they don't pay a dividend, EV to EBITDA is our best secondary lens here. It strips out that heavy interest burden, looks strictly at operational cash flow, and frankly, makes the stock look ridiculously cheap. Okay, let's tie this whole thing together. Part 6, Synthesis and Final Verdict. When we view all these legendary frameworks side by side, the picture gets pretty clear. We've got a company that Buffett heavily penalizes for its massive debt and choppy short-term earnings. But on the flip side, Graham shows us it is undeniably cheap against its hard assets. And the EV to EBITDA multiples highlight some serious long-term operational potential. Lynch and the DCF model, they sit right in the middle, basically telling us to hold tight and wait for this turnaround to actually show up in the cash flows.
So, is OI Glass a broken company or a perfectly priced turnaround? Given the mountain of debt, energy inflation, and all those cyclical risks, I'd say this remains a speculative hold for most standard portfolios. But if you are a patient value investor, someone willing to trust that insider buying, believe in the fit-to-win cost savings, and weather the European energy storm, at $9.23, OI Glass is a truly fascinating calculated risk. So what do you think? Does that steep discount to its hard assets completely outweigh the massive looming debt? Let me know where you land on this one.